when we look at LATAM from a fintech and payments perspective, it's essentially the third largest market in the world after the US and China, and it's bigger than India. With AI and the whole thing, if I was already like very paranoid, I'm orders of magnitude more paranoid now because, you can disappear any minute. If there's great football players, soccer players that can develop their careers in Latin America and then excel and become the best in the world globally, why not building companies? We started the company in 21 and we did our seed round and then the Series A, most of the B and the C over Zoom. I mean, you are on a Zoom call with Index or Insight, all these great funds. They hang up with you and the next minute they're talking to a founder in any other part around the world. So you are effectively competing against the best globally. Every time I join a Zoom call, I believe that I have to be better than the Collison brothers or the Revolut CEO or whoever is best in the world.
Gastón, it's a pleasure to have you on the pod. Welcome to the J-Curve.
Thanks, Olga. It's amazing to be here and glad that you made it out to Buenos Aires this time.
It's very interesting how much everything that you do with Pomelo has evolved over the course of the last couple of years. But I want to go back to the beginning a little bit for those who were not part of the J-Curve community and those who haven't listened to our first conversation, which I, by the way, highly recommend. So initially, you were the CEO of Naranja X. You built a neobank with several millions of customers in Argentina. You were competing with Mercado Pago and Uala. Back then, you said that 80 to 90% of the friction and the frustration at that company was all related to infrastructure. So walk me through how that experience led you and your co-founders to starting Pomelo.
Yeah, I mean, that's absolutely right. We built Naranja X, which is, today a very successful neobank. Not only in Argentina now, they started to expand to several other countries, including Mexico. So delighted to see them grow and do very, very well. But yeah, during the early days, I remember much of the effort, the funding, the team that we hired and the problems that we had, most importantly, the problems that we had were related to the infrastructure. Basically, what happened was that as we were trying to build the neobank, we had to put in place the basic infrastructure to be able to scale. And we struggled to find the right vendors and the right partners, mainly because in Latin America, not only in Argentina, but throughout, we had to deal with lots of local incumbent players. Companies that were built, 30, 40, 50 years ago to serve the first wave of digital financial services, mostly to serve the banks. And even if you look today at most of the fintechs throughout the region, they are still sitting on top of that legacy infrastructure because when we first started to see the fintech wave in LATAM, 7, 8, 10 years ago, they were the only option. So kudos to them because many of them were successful and continued to grow, but they had to, put in place their initial offerings on top of that legacy infrastructure. Fortunately, in the last few years, thanks to Pomelo and several other players operating in the space, they've been able to change and to improve and to move away from incumbents and to adopt modern technologies that allow them to scale. But it was ultimately that pain that we went through and that experience and all that sort of suffering that led us to thinking about a thesis around infrastructure, not only for Argentina, but for the region. Because in fact, we had previous experience working with the entire region. For instance, my co-founder, Hernan, was the third employee in the history of Mercado Pago. So he worked a lot with the wallet and with the card at Mercado Pago and helped scale Mercado Pago throughout the region. Same, my other co-founder, Juan, who was at MasterCard, selling MasterCard into the fintechs. They also encountered this problem, not only in one market, but across the region. So ultimately, what we realized is that the most successful companies would want to tackle all of Latin America in a very different way to how they had to do in the past. And that, gave birth to our regional thesis to build a completely different infrastructure.
The way you did it, it was a very contrarian, I thought, and I still think that it goes directly against the standard startup playbook, because instead of focusing on finding a product market fit in one of geographies that you knew exceptionally well, for example, as you do with Argentina, you build across 6 markets almost simultaneously. So what gave you the conviction that this regional approach has to be implemented from day zero, as opposed to figuring basic things out, testing unit economics, testing market adoption, finding product market fit, and then rolling out?
You are absolutely right. It was 100% contrarian, totally unconventional, because the typical startup playbook would tell you, just focus in one, business idea in one market. Then if it goes very, very well, after several rounds, you can expand to
Cautiously.
cautiously. Yet with our very first round, which was a meaningful seed round, $10 million, but still in the scheme of things, not that much capital to go to, an entire continent, we did decide to go to 6 markets straight away.
Which markets were those?
Those were Brazil, Mexico, Argentina, Colombia, Chile, and Peru.
So you just decided to go to the biggest markets in the region on the $10 million raise.
Yes. Since then, we have added Puerto Rico and Panama, and we're now in the verge of adding several others. In fact, we're kind of going global with some of the products that we have. But yeah, it was absolutely contrarian. But we did it because we were 100% convinced, like our confidence level in that thesis was extremely high, precisely because of what I mentioned before. We had suffered from this in the past. So ultimately, we decided to build the company that we would have loved to hire and to, buy from during those previous experiences. We also knew that both local companies and global companies would want to look at Latin America and execute Latin America in a completely different way without having to go market after market, partnering with several partners and incumbent players in every single market. There was a very clear trend, and that we could help companies not only do one market or another market, but the entire region. And that's been sort of the core value prop. And if you look today at our most relevant customers, the ones that generate more volume, the ones that generate more revenues, the ones that are happier with Pomelo and have the higher NPS scores, are regional companies. Either because they were born in one Latin American country and we have helped them expand to the other ones, or because they are global companies, including some global banks, that come to Latin America and want to execute this region as part of a global strategy. So it's very handy for them that a company like Pomelo allows them to do an entire region and centralize all of the infrastructure with us.
If you were to think as an investor, for example, how would you think when this approach is right for founders, especially founders who build infrastructure? Because it varies, right? There's a lot of local elements to it.
We do believe that in emerging markets and in Latin America, it's a natural hedge, and it's actually, ultimately a competitive advantage, because, this part of the world is volatile. Every single market goes through its own cycles. And look, we have started the company less than 5 years ago. Argentina was a complete disaster back then. Now it's a, global trending topic. Brazil, went through its ups and downs. Same happened with Chile, Colombia. The continent and every single market swings from the right to the left, from the left to the right. Things go better, then they go worse, and so on and so forth. So the fact that we are present in 8 markets today, it is indeed kind of a natural hedge, because there's always markets doing well and there's always markets that are struggling. So they kind of net out each other. Having said that, it's also tricky to prioritize, and there's always this discussion, this tension. Hey, should we invest 80% of our funding and resources into like Brazil or Mexico? And even there's a case to do 100% and then leave the other ones sort of behind. So that's probably the most difficult part of our job from a resource allocation perspective. What countries, what markets we do prioritize, and when and why. But in fact, it goes beyond that, because it's also related to, the customers that we're serving and the use cases that we're serving, because ultimately this is a B2B business. And in B2B businesses, you need to hear to your customers, especially the largest customers, and stay very close to them and grow with them. So sometimes what happens is that very significant amount of growth comes from a customer in Colombia or a customer in Chile, and that it's counterintuitive. Another thing that it's also worth mentioning is that many times you're developing capabilities for Chile or Argentina or Colombia, but then you can repurpose that capability and use it for Mexico or for Brazil, because 60, 70, 80% of what we're doing for one market, it's useful for the other market. So then you have to go and do the last mile and tropicalize for that second, third, fourth market. But ultimately, we are always building that sort of regional capability. Some investors, to your point, do understand this. Some investors, most of them do not understand this, do not like it. But ultimately, we think that, our own value creation lies there. And we've been, been, pretty successful thus far. And at the end of the day, as a founder, you're looking for the right investors. You're not looking for every single investor. So as long as we have a board that understands that supports that challenges us in terms of, when and where to invest, that's ultimately what you want.
We'll talk about your stellar cap table, and I guess the most recent round is another vote of confidence from your investors. But I'm curious, with that strategy, with that GTM in mind, what are the key competitive modes that teams should have? Obviously, execution excellence, but what is the key stack that you think that you have that allow you to do this very successful rollout regionally and soon globally?
Going back in time, the very first decision that we made from a hiring perspective was, and in many ways we continue to hold it today, was we only hire plug and play people. Because financial services are so complex and in many ways complicated, people tend to think that they scale very well. And some parts of financial services scale very well, but many others don't really scale because they are very different from market to market based on regulation and how business works in every market. That tapping into that sort of knowledge in every country was very, very important. And we had a very vast network of great people that had been working with us in the past while building the neobanks and several other companies. And we knew that if we hired plug and play people, our execution would improve dramatically, not only in terms of speed, but also in terms of quality, because the teams and every single person individually had previously gone through that kind of learning curve. And in many ways, we continue to have that sort of hiring criteria. And I think that has given us a lot of quality, a lot of depth into the problems that we're trying to solve, and ultimately execution. Then, of course, that alone, is not enough. As I said before, being very, very close to our customers and having a lot of customers being design partners along the way is very, very important, because you are essentially doing an explicit agreement with your customer that you're going to design something for the first time, and hence it might go through difficult times, or you might have bugs and all these kind of things. But ultimately you are doing it because you are giving that customer something new, and you're giving that customer, a first mover advantage doing whatever they want to do. But you're also developing your own company and sort of leading the way with new use cases and new technology that you can then over time use for other customers. So I think that has also been very, very important for us. We also see, compliance, regulation, AML, legal, all these functions that, many times are seen as kind of boring. We see them as value prop. We really put them front and center, because in financial services, you really need to build trust, and you really need to be able to build compliant products, because ultimately you're dealing with, money from people and from businesses in a regulated environment in multiple markets. So we take that very, very seriously, and we always start our new product and business development with those teams and making sure that we are within that kind of framework. And only then comes the product team to design the product or the solution per se.
On the product side and in scalability in between 8 markets at this point, right? What was your approach towards rolling out product? How do you balance being a solution that is generally true for every market with a healthy amount of localization that each of those markets require?
So it goes back to this idea of, at the core, most financial services work in a similar fashion, but at the same time, they all kind of operate differently in every single market. So for instance, if you have like a credit card that was issued in the US, and then you have one issued in Brazil, and then one issued in Mexico, you will notice that they have a lot of commonalities. You go to the restaurant, you pay with your credit card, you have to pay your balance at some point in time, otherwise the interests kick in. So all of that is very similar, but then many things are different from one market to the other. If the interests are capped, if the company, in this case, our customers have to file reports to the regulator, and so many other things, right? And so ultimately, when we build a product, we are building that first sort of 70-80% that it's kind of universal. And then we're tropicalizing on top of that. So even if we might go first to, we'd say with a credit card product, we went first to Mexico and then to Brazil. But then what might happen is that then, we were able to land, a very important credit card customer in Chile. When you already have that 70-80% in place, and then you have already topicalized a little bit for Mexico and for Brazil, then what you have to do for Chile is really only like 10%, 15% or so. Because it works that way, you can do Colombia, Argentina, third or fourth. And ultimately, every single market gives you an incremental value towards the entire system. So we don't obsess too much about, hey, this new feature, we're developing it for like the wrong market, because there's no such thing as a wrong market as long as ultimately you are contributing to that central pool of value proposition. And that gives us the elasticity to be able to serve different customers in different markets and to add new use cases along the way very, very rapidly.
What did you choose not to do back when you started several years ago? And what are you still choosing not to do right now as the company grows?
It's interesting because we have done many things, but at the same time, we have done only one thing. The one and only one thing that we have done up until now is, card issuing and processing capabilities. So if you think about all of the payment rails that are available to people these days, like in Latin America at least, there's four. One of which is analog, which is cash. Then we have cards that have been around for several decades. We now have real-time payments, obviously PIX, and then the other ones that are starting to emerge in Mexico and in Colombia and Argentina, and so on and so forth. And then more and more stable coins as a payment rail themselves. So we have only worked in and for one of those rails, which is the cards rail. And within the cards rail, there's two sides to a transaction. There's the sort of the issuing piece, and then there's the processing or the acquiring side of things. And we have only done the issuing side of things. So we have done, let's say, to put it in very simple terms, only 50% of one rail, which is effectively 33% of the digital rails or 25% of the rails altogether, right? So it's 50% of 25%. So from that perspective, I think we have been very, very focused. And now on the back of this round, we will start doing some new things. But it's been 5 years, right? So from that perspective, it's been 5 years of absolute focus, right? Within that scope, we have done many things. And we have designed the platform, as we have been discussing, in such a way that it's very elastic, that can serve multiple markets, that can serve multiple customer profiles, because we serve everything from very large global banks to local unicorns, global, public companies, and the next fintech that is emerging on the back of a seed round.
How do you position and how do you manage to sell into such a diverse segment of customers?
So I think the same way we have been regional by design and we've hedged the business, we've also been sort of generalists by design. Today, if we look at the traditional banks, we work with BBVA, with Santander, we work with BCI, which is the largest bank in Chile, Bancolombia, same, largest in Colombia, and several others. But then we also work with some of the fastest growing fintechs globally and locally. So you have AstroPay, Dollar App, Story, even beyond fintech, Rappi, Lendable from the UK. Then if we tap into the crypto space, we work with the largest crypto exchanges globally, namely Binance, Bybit, but also the local ones, Mercado Bitcoin, Ripio, Bitso, Velo, and so many others. And then we also work with some embedded finance players that have nothing to do with anything that I just mentioned. So for instance, a very interesting case there is Metropago from the subway in Santiago de Chile. So we power the subway in Santiago de Chile that issues cards for users to pay for the subway, but not only for the subway now that card allows them to go and do their groceries. So it's a very wide range of customers, and obviously there are different profiles and they're different in nature. And you have like the 3-person startup that wants to go super fast, doesn't care if everything breaks, and then you have like the very established tech company or incumbent bank that it's very, very compliant and it's slower, but at the same time has a book of business that is significantly larger and can make up for like 20 or 30 of your other customers. And you need to handle those relationships in a completely different way with more involvement from the founders. But then you have to be able to come into a meeting and, have your, chief risk officer and your chief legal officer and your chief compliance officer to talk to them and be, at the same page and have the knowledge that that financial institution requires. Obviously, this is the current mix of customers. It hasn't always been like that. When you're selling infrastructure at first, almost by definition, nobody trusts you. So our very first customers were, early stage fintechs. And I think we benefited from the fact that we were born in 21. And so we were able to work with a lot of companies that had raised, seed rounds and Series A's, some of which are doing very, very, very well, and some are gone. They weren't able to, raise again or to find product market fit. But by working with us early stage fintech, we got the rights to work with a, relatively established, maybe Series B fintech, and that gave us the right to start working with some unicorns, and that allowed us to tap into global unicorns. And then if you're working with unicorns, the more incumbent sort of banks start paying attention, and that gave us the right to tap into the banks. And so now when you look at the portfolio, it's a mix of customers, but internally we have prioritized and reprioritized and changed the teams and evolved the teams and hired new profiles to be able to serve each one of those segments as they want to be served, which is, in my opinion, a very important comment, because, a 3-person startup doesn't want to be served the same way a bank is served, and a bank needs and almost requires that you put the right people in front of them and that you don't feel like a startup. So Pomelo should not feel like a startup to a large bank. So internally, the company is very, very well segmented and very, very well focused to serve those different customers as they want and as they deserve to be served.
It's funny, but that's how I build the podcast. So you start somewhere and then you build this social validation and trust by association and by delivering a track record in this initial segment. And then you just expand from there and you grow your pie, basically.
Yeah.
It's totally fascinating how this applies to completely different industries.
Yeah, and it not only goes to the team. Obviously, the technology and the product has matured a lot over time. And then, we started to file and obtain more and more regulatory licenses and cybersecurity, certifications and compliance certifications and so on and so forth. So, as a company, your entire asset becomes more appealing to these more sophisticated customers, and you start to develop more and more based on what they need. We have also fired customers, it has to be said, because if a very early stage customer from the past wasn't willing to pay, a minimum amount after we went through pricing changes and so on and so forth, we started to have negative return on investment, and it simply didn't make any more sense for us to serve those customers. All of that, it's easier said than done, but we have been creating and building and evolving our own framework. It's not easy, but at the same time, you're kind of unlocking new market share. You're unlocking new TAM when you go to a new market, when you go to a new market segment or customer segment, when you, build a new feature, a new product. So ultimately, it ends up being kind of traction driven, and the numbers play an important role there. But then to your point, also, like the team, part of the team remains there, and there's people that, have been with us for almost 5 years since the very early days and from the garage. And then there's people that were very good for the first year or 2 years, and they are not interested in the kind of the scale up phase of the business. And maybe we didn't see in them like the best possible fit for the stages that we needed to navigate. And that also led us to recruiting different people. And this can be seen all the way from like our country managers that have become a little bit more corporate, some of them even coming from the incumbent players with great networks and very well-established business relationships in the respective markets. And then simply people that, are plug and play.
We are now at 370
about
something
300
people. What's the percentage of plug and play people versus actual specialists who excel in specific domain and who are less transferable?
No, it has always been more than 90% plug and play. But
so it stayed the same?
Yeah, it has stayed the same. I mean, very few times we brought someone that had the skill set but didn't have maybe like the fintech or the startup or the scale up experience. Because if you can get the hold of both the knowledge and the prior experience, even better. Sometimes you can't. But if you can, I think, that saves you a lot of, time and therefore money. I like to see this a lot, for instance, with the marketing profiles. When I started my own career, for marketing profiles, it was very aspirational to work at CPG or FMCG companies. So the profiles that came from Procter & Gamble, Unilever, and so on and so forth were the best marketing profiles. Some of them were able to recycle themselves and to go to tech, but they had a very hard time ramping up to tech because marketing in tech is very different from marketing in FMCG. In many ways, it's less interesting because in FMCG, it is more of business management, and in tech used to be more growth related or brand related. The scope tends to be a little bit narrower. So if you're looking for your head of marketing, then you do want, or at least in my experience, I have always wanted to have people that went through those sort of FMCG schools and had a very good framework and were business minded. But I also wanted them to have that previous tech experience, because that means that someone else paid for that ramp up and someone else has sort of de-risked our decision to hire that person. And that's a good definition of plug and play. Someone that has, the technical knowledge from like Procter & Gamble or Unilever, but also has the proven experience having worked for Uber or Mercado Libre or someone in tech, right? And that definition of plug and play varies over time. So for instance, one of our last key hires is someone who was leading all of the financial institutions for MasterCard in Chile, and he had previously done a Harvard MBA. So he's a very solid profile, but it's a profile that is very, very well suited to serve the large financial institutions. And that's a very different profile from someone who has been working at Pomelo for 5 years or so.
How do you take all of those people from very different backgrounds, different skill sets, and align them in terms of corporate culture that is uniquely Pomelo's?
That obviously is a difficult element, but I think we more and more put a lot of time and effort into understanding if it's the right profile from a cultural perspective before making an offer. And I push a lot for that. I like, for instance, having engineers interview lawyers, or lawyers interview designers, or designers interview
interview designers.
Yeah,
That's
because
good.
ultimately, their role in the interview process is to defend and to continue to raise the bar from a cultural perspective. So if a lawyer is interviewing a developer, they're not interviewing for their technical skills, they are interviewing for, the cultural fit. And that's their role in the interview process. So I think if anything, we have become more and more deliberate about that kind of, process, just to make sure that when we hire someone, that person is already a good fit with Pomelo or has very quick opportunity to become that kind of profile.
I want to talk about so many things and unpack on some of the things that you said, but I want to start with how you think about the market and how did your thinking about how big this market is and what Pomelo can become has evolved since when you started.
When we look at LATAM from a fintech and payments perspective, or let's say Latin America, including Central America and the Caribbean, it's essentially the third largest market in the world after the US and China, and it's bigger than India. So it's already a very large TAM. And effectively, the only thing that we have done thus far is go from 0% market share to some tiny bit of market share. We're still in this kind of initial phase where we're trying to become the new normal and the default option for what we do. Our win ratio when it comes to net new market share is incredibly high. Then in infrastructure migrations and, ripping and replacing incumbents and taking market share from others is feasible. In fact, I'm always surprised by the fact that almost 50% of our customers have previously worked with a local incumbent, but it takes a long time because a migration decision or bringing in a new vendor for a net new product is not a simple thing to digest, especially when you're talking to more corporate decision makers, because there's a lot of risk involved for them. And in many ways, the easy decision is just to perpetuate the status quo. Of course, I do think that there's an opportunity to do more, and we're starting to unlock some global products, and slowly but surely we'll start becoming a company that serves markets and customers beyond Latin America. But that in many ways is being possible, and it's becoming a reality because we realized that when we were developing for Latin America, ultimately the product that we were bringing to life could also serve customers in other regions. And I think that's a more organic and a more natural way to do it. And there's less risk involved because we didn't have to make one big, bold decision, and we didn't say, okay, let's go global. You would be surprised by the number of customers and potential customers that ask us to serve them in other regions. So we have had customers from Latin America that have been asking us or inquiring whether we would do the same thing for them in South Africa, in the Philippines, in India. European companies that ask us if we would look at the at Europe and the European Union as a next market because they're not happy with what they get locally.
It's very interesting, the last part to what you said, that there are Latin American companies that are going globally and they would prefer to do that with you than go and search for a potential partner in the market like the US. Timing plays an interesting thing into that, right? Because like 10 years ago, we would not be having that conversation about the Latin American companies who are going to global markets. But right now we can have this conversation. And we were talking with Hernan before that there's like a cohort of companies with global potential waiting for the IPO window to open. And everybody thinks about like IPO in NASDAQ and New York Stock Exchange. So it's very interesting how your growth and your strategy, this kind of strategy built around expansion plans of your customers, plays into your ability to get into potentially much bigger TAM pie when you think about the global market opportunity.
So I think there's two elements to it. One is from a historical perspective. At first, as you know, a lot of the first, second wave of LATAM entrepreneurs were sort of doing copycats of US companies.
The Uber
and
of
then,
this, Airbnb of
yeah,
that.
and so on and so forth. And then over time, and thanks to AI and in the fintech space, stable coins and crypto, more and more LATAM entrepreneurs have started to do things for the world. So that's kind of one angle. But ultimately, I think there's a second factor, which is a self-esteem issue or problem.
Underdog syndrome, you mean? Or
yeah, listen, like I love all this sort of business and sports analogies. As you know, like in Latin America, we are great at soccer. Argentina, Brazil, Uruguay have won multiple World Cups over the years. And there's many other great football teams and football players from countries that have not won World Cups, but they have played for the best clubs in Europe and in the Americas, and they have won all sorts of awards and trophies and so on and so forth. So if there's great football players, soccer players, or any other athlete for that matter that can be born and develop their early stages of their careers in Latin America and then excel and become the best in the world globally, why not building companies? It's the exact same thing in my opinion. So if you have like a soccer player that started playing for Boca Juniors or for River Plate, and then they won like the Copa Libertadores, and then they made it to the national team, and maybe they were sold to like a tier 2 European team and then to a tier 1 European team, and then they won the Champions League and they became amongst the best in the world. We can do the exact same thing. So ultimately, if you're building the best possible technology in Latin America or in Africa or in the Middle East or in Southeast Asia, and it's arguably the best, then you can compete with that asset and sell that asset around the world. Back to Pomelo, if we are being able to develop some of the best pieces of payments products from Latin America and for Latin America, there might as well be, and we're proving that there is a very clear opportunity to commercialize that very same product or a different flavor of that product globally. And that, of course, will yield new opportunities and new funding rounds and new challenges for the company, but also a lot more time and growth.
You were mentioning in the beginning that a lot of investors might not understand the strategy. You just need to find those who do. And somehow you manage to find those who do, who are also top of the top, creme de la creme of investment community. Here, we're talking Kaszek, we're talking Monashees, but also globally and US specific. We're talking Inside, because Inside, they invest in companies that solve problems in the industries of their interest. So they select you not based on the geographical principle and compare and benchmark what you do against other companies in the geography. They select you as a world-class company. So tell me more a little bit in terms of building those type of relationships and prove that you are that type of, like, you are a world-class company that happened to come from the region with a very differentiated and contrarian strategy to the extent. How do you help investors build conviction around that? How do you position yourself in front of the right investors? How do you get the deals done? And how do you build and manage relationships with your cap table following the deal?
Yeah, well, there's a lot to be said along these lines. The way I think about it is, as with the soccer players, I also want to be, and the team wants to be the best in the world, and we want to be proud about it. Of course, you first have to believe that you can be that sort of top-notch, professional CEO, team, company, and then you have to execute on the back of that for a very, very long period of time and have the numbers, on the real traction track record show that you are within that small group. The second thing is you have to live to those standards. So you have to first identify what those standards look like, what your gaps are, work on your gaps, close those gaps. But you ultimately have to perform at that very, top sort of level. So every time, and we started the company in 21, and we did our seed round and then the Series A, and I think most of the B and the C anyways, over Zoom, right? And it's a global market. I mean, you are on a Zoom call with Index or Insight or Kaszek or Monashees or all these great funds, and they hang up with you, and then the next minute they're talking to a founder in any other part around the world. So you are effectively competing against the best globally. So I don't know who the best fundraisers are today in the world, but every time I join a Zoom call, I think and I believe that I have to be better than the Collison brothers or the Revolut CEO or whoever is doing best in the world. And so part of my job is trying to identify what great means for a CEO, for a leadership team, for a company, ideally a few years ahead of the event that we're pursuing. So for instance, when we closed the Series B, the first thing I did was I incorporated all of the feedback from the round and said, okay, these are some of our clear gaps. And if we want to be a Series C company, we have to close all of these gaps. And we have about 2 years to not only close them, but become the best in the world or the best in the region. So now I'm in the process of doing the exact same thing. What does a Series D company look like? And what's the gap, or what are the gaps that we have? I have individually. The team has, as a team, the company has as a whole. And so we are already in, the closing the gap mood to be able to optimize and maximize our chances of doing the next round. The round is a very graphic way to put it because the funnel is so steep that, you can measure it in terms of rounds. Should you want to raise the next round. But on that note, something interesting that happened to us, like after closing the Series B 2 years ago, and it was a very rough market. It was the end of 2023. It was horrible for VC. It was horrible for LATAM. It was horrible for Fintech. And we managed to raise, I think that year there were only like 4 or 5 Series Bs in LATAM. Now we closed the C, and I think there were only like 2 or 3 Cs in LATAM in the last 12 months or so. But the very first thing I did was, I listed all of the things that we learned. And ultimately, I narrowed down that to like 3 items. And I shared them with the entire company. And I told them, like, these are the things that, we failed on, even though we were able to raise the round. Because also bear in mind that when you raise a round, more often than not, you are being rejected 90, 95%, 97, 99% of the time. So there's a massive opportunity for any CEO and any company to learn a lot in a very short period of time. And we took that as an input. And in fact, in our 2023 end of year company or investor report that I write for all of our investors, the first thing that I did in my memo was to include what the 3, findings or learnings were, and then explain how we were, thinking about approaching them in the years to come. And I was actually very surprised by the number of top tier investors that came back to me and said, this is literally the first time that I read such a thing from a CEO. Acknowledging all the things that you didn't do well or that you learned.
So wait, you sent it out as a memo?
Yeah. The opening paragraphs, like the first 2 pages or so of my end of year 2023 memo, were all the learnings on the back of the Series B. And actually now, like this very same week, I have to send out the 2025 end of year report. And because we have just closed the Series C, I will do the exact same thing. But it's interesting because the VCs and the investors, they have this feeling, or some of them anyways, that whatever feedback they provide to the founders, it's not being taken in consideration by the founders or the CEO. And at least, we take it, and I take it very, very seriously. You might agree, partially disagree with what you hear from the market. And obviously, there's a lot of nonsense in some of the feedback that you get. But there's also a lot of wisdom. And I think if you use that wisdom, in the right way, and you develop an asset and a capability on the back of that, then you're better off. So I think that's a good exercise to do. But most importantly, and probably tapping into your original question, I realized that was a massive source of trust for my existing investors and for my potential investors, because I did share that report with some non-investors that had actually rejected me multiple times over the years. And I think it helps build trust, because ultimately, like, they want to invest into people that are, coachable and that will incorporate feedback and that will learn from the mistakes. Or maybe you didn't even make a mistake, but you were just like not paying attention to an opportunity.
Now I'm very curious. What are some of the reflections that you think helped you to get from Series B to Series C, and some of the interesting things that you have to work through to be a Series D company?
I think you also have to put the feedback in context, right? Because VC goes through lots of ups and downs, and I'm always surprised by how cyclotimic investors and funds can be. So you have to take it, with a grain of salt. But for instance, back in 23, a very real piece of feedback was the burn profile. And the burn profile was a byproduct of the fact that, as you pointed out, we in 21 decided to go to 6 markets with the seed round. And that meant that we had to front load the business, and we had to invest very heavily into like different markets and different products way ahead of time. And so that also meant that, 2.5, 3 years into Pomelo's story, we were very clearly picking up traction, but that traction wasn't enough as to net out the investments or the burn that we had taken on. But in 23, the market was in a horrible situation, and the market in general, most of the funds anyway, weren't willing to digest a burn profile of that nature. Now, very few took the long-term view, and they understood that maybe like with 1 or 2 more years, you would be in a much better position. And that's exactly what happened. And now, our ratios are in a very, very good position. And you would also be surprised by the number of funds that, when I talked to them at the Series C, they went back to their Series B notes and said, wow, I'm surprised because you said that you would do A, B, C, and your ratio would improve in such a way. And effectively, you did it.
You actually did it, yeah.
Yeah, but I mean, for us, it's always been natural. I mean, we try to be like super transparent. We have a plan. We try to execute the plan. Sometimes we might, overachieve or underachieve, but ultimately, we commit to something and we do that very same thing. But apparently most startups don't work that way, or the difference or the gap between what people promise and people execute seems to be like incredibly larger than what we're used to, right? So point being is that investors do like that a lot. And that's also how you build a lot of those relationships and your trust, because you become a trustworthy person that says something and then goes and executes whatever you said you would. And just to give you an idea, we more than tripled the size of the business with the exact same amount of people. We made that very explicit decision, which was, from now till the next round, the headcount is not going to change. The one thing that has to change is our revenue curve and, the customers that we serve. And that's exactly what we did. And yes, as you said, like Insight does invest in LATAM. Obviously, it's not their backyard, and they invest a lot more like in other regions, but they have a good fair amount of investments in LATAM. Index, I think they only have like 3. This time around, we were joined in the round by Adam Street that is doing their very first Latin American investment.
Have you invested in building relationships with them before?
Yeah, we had been talking and working with them in different ways for the last 3 years or so. Still, I mean, there's probably other companies out there that did the same thing.
I actually think that you would be surprised at how many companies, they talk about that. They rationally understand that it makes sense to go and build relationships, but they either don't know how, or they just don't do it like consistently. I would not be surprised if you would be maybe one of the few companies who actually invested in building relationships with Adam Street partners in Latin America.
It could be. I should probably ask them. But listen, like not all relationships are the same, and you never really fully understand or appreciate what the other party is looking for.
No.
It also has to be said that there's been relationships with, very relevant logos and funds out there where I have de-invested over the years. Some partners, some people, some firms, you simply don't, it seems like you don't fully kind of understand each other. I have been rejected by the same people and the same funds like maybe 4 or 5 times in the last 5 years. And some of them I continue to invest in the relationship because I think it's a timing thing or it's whatever. But it's just like the particular dynamics of the round that didn't serve the purpose, but I still think there's opportunities in the future. And in some other cases, no, I have refrained and cut, in a good sense of the word, those relationships because I simply think they don't yield a positive ROI on my time.
How do you handle rejections? Like when you're rejected 4 times in a row, like how do you handle that?
There was a time where it would hurt. I still remember, like, because before Pomelo and before Naranja X that you referred to, like, I've been building companies for about 13 years now. And I do recall the very first time that I was rejected by an incubator. This was back in 2013. Remember, like, you would go to an incubator, they would give you like $25,000. So I was living in Europe, in Ireland, and I went to Berlin for like 2 weeks and did this kind of program. And there were 20 companies and they shortlisted 10 and they invested 25K into 10 of them. And I was rejected. And this was, having resigned to my job in Google. So it was like I was working at Google and I was invincible. And then, all of a sudden I got rejected from the
from the incubator.
From the incubator for a 25K check. And I was absolutely destroyed. I remember being in Berlin for like an entire weekend and I couldn't move. I was completely devastated. And this time around at the Series C, absolutely no rejections hurt me. Like none, zero, no pain. A lot of learnings, right? But no pain. And I think it's important to separate both things.
It's like a muscle that you build.
Absolutely.
Handling rejections.
Yeah, absolutely. And ultimately, I think it motivates me. You asked about, what's up with the person or the fund that has rejected me and Pomelo 4 or 5 times. And I can very quickly tell you, like, 4 or 5 of the big names that have consistently rejected us. I won't mention them, but I always have them top of my mind. And it only motivates me to prove them wrong.
It puts fuel into the fire.
Yeah,
right?
absolutely. To prove them, not to prove them wrong, not as in a confrontative thing, right?
I don't think it's about them even. It's more about,
you
us. And using like that as a fuel to run faster.
Yeah, exactly. And many times it's about showing them that either the LATAM factor or the investment factor or the way we approach the business that they are assessing is only like a moment in time. It's like a photo, it's a picture, and that they still have to see the rest of the movie and how it plays out.
I'm trying to remember our last conversation and I'm going through my mental notes, and I think you have evolved as a leader so much over the course of this last couple of years. What is the main change that you have noticed in yourself, both as a leader, but also as a person?
Yeah, it's so difficult. Some personality traits stay with you forever.
Yeah.
The good ones and the bad ones, or the ones that people don't appreciate, even though you might think they're an asset. And then some other things you simply change. With AI and the whole thing, if I was already like very paranoid, I'm like, orders of magnitude more paranoid now because, you can disappear any minute. Yeah, I'm more geared towards action than ever. I try to work incredibly hard and lead by example from that perspective, but I'm more aware than ever that the more sort of CEO and generalist you become, the least prepared you are to make more sort of technical decisions. One thing that I've been reflecting a lot lately, and it's one of the reasons why we've been investing a lot into the leadership team, is that if you think of it from an organizational design perspective, it's very risky for a company to have just one CEO and 2 eyes looking at things and making decisions, because the propensity for mistake is relatively high. So I've been thinking a lot in terms of how do I de-risk my own decisions. And obviously, CEO is a role that requires making a lot of decisions. You don't have to decide by yourself or alone. And obviously, working with people that can inform those decisions is very, very important, or even make those decisions depending on what it is. But you still do a lot of micro and macro, small and very large decisions every single day. And in many ways, it's somewhat risky. So I more and more like the idea of having someone who is empowered to pretty much make the same decisions that I have to make, and so that we can compare notes. And it's one more instance that allows us and allows the company not to make a mistake, right? So effectively what I'm saying is, if I bring sort of, a chief of staff or a COO or a CFO or whoever might be to a situation where they feel and they can act as a second CEO for a specific decision, then at least we have two people trying to make one decision as opposed to just one. And I think that's a huge de-risker. But no single organization is designed that way. I don't know, it might be crazy, but I've been thinking along these lines lately. And so I'm trying to build these kind of de-riskers in high stakes decisions that are
like
made.
one door type of decisions as
Exactly.
per Jeff Bezos. Let's talk about AI before we move to the rapid fire.
Okay.
I'm curious about how you think about the impact of AI on Pomelo as an organization. And I'm pretty sure that is something that allows you to increase revenue per head while maintaining the same number of people in the team while launching all of those new products and so on and so forth. But also in terms of where do you think AI will have a massive impact on the operations?
So first off, to put it in context, like I remember prior to sort of the AI wave, anyone who worked in technology would be very proud of not having to go through a digital transformation process. So for instance, when we were building the neobank before, we would, of course, argue that the incumbent banks had to go through, their own digital transformation process, and that would make them slow and so on and so forth. And the reality is that for any company that wasn't born and designed in the last, give or take 2 years, 3 years, we have to go through a digital transformation process kind of thing, right? Which is like an AI transformation process. And it's interesting and it's kind of scary that we are less than 5 years old, but we already have to go through a transformation of that nature, right? And that, caliber. But it's true. And if we don't acknowledge that, there's a massive risk that we end up losing in the long run. So that's the first thing. I mean, you have to have that awareness and sense of urgency around that. Then in very simple terms, the way I think about it is kind of in 3 layers. The first one being operational efficiency. And I think to your point, and I mentioned this before, that's kind of what allowed us to go in the last 2 years, from X amount of revenue to more than 3X that amount of revenue with the exact same amount of people. And I think most of the companies are starting with, operational efficiency, and it's easier to see in B2C companies than in B2B companies, but the opportunities are clearly there. I think the second layer is how AI can help you deliver more and ship more roadmap in the same amount of time. So for instance, today, more than 50% of Pomelo's code is written by AI. So all the unit tests, the PRDs, bug fixing, and,
Do you use Lovable at all?
I don't. I'm not sure if the team uses it.
It's funny, like they're so valuable, but everyone I ask doesn't use Lovable. Okay, anyways.
But anyway,
50%.
More than 50% of the code is written by AI. So effectively, obviously, and the role of the developer is changing, and it's becoming more of a prompter and has to have more business acumen and all these things that everyone already knows. But ultimately, a point that I'm trying to make is that second layer is about leveraging AI to be able to ship more roadmap in the same amount of time. And from the latest numbers that I have seen, we were kind of up 40% or so in terms of the amount of initiatives that we are able to deliver in any single quarter vis-a-vis a year ago, right? So that means that with the exact same amount of people, leveraging AI and of course going through upskilling and so on and so forth, the amount of roadmap that we can ship in any given quarter has increased by 40%. But at the same time, that's not enough. It should be 50% next quarter and 60% next quarter. So I was actually discussing with the team just today that every single sub-team within engineering has to have this OKR to go at least up by 15% quarter over quarter, because that's essentially just being able to keep up and maintain your productivity, like probably not even like increasing your productivity. Just because you are describing that sort of, adoption curve with vibe coding and AI in general. So the expectation is that, you deliver more every single quarter. If you're a customer support agent, like, 10 years ago, and you're doing 10 tickets a day when you first, join a company, by month 2, you should probably be doing 15. And by month, 3, you should probably be doing, 20. That's how it used to work. When I came into Google out of university, I was reviewing ads, and the amount of ads that I had to review per day or per week, it was very different during my ramp up than, 6 months in. And the same applies to developers and to AI. So the very first thing is to measure it and to be able that we put OKRs or goals against that. And at first they can be just arbitrary because you don't really know what, a good number is. I don't know, to be honest, if 15% is aggressive or is conservative, but at least we need to have some sort of number. But anyways, the point being is that kind of second layer is being able to do more with the same amount of, investment or people or tools or however you want to put it, right? The output of your roadmap increases thanks to AI. And then I think the third layer is about really having some sort of AI related value prop or AI boosting or increasing your value prop. And if you do so and you are relatively successful, then you will not only be able to compete with AI native companies, but also you will be able to extract economic value from that incrementality in your value prop, because there will be more willingness to pay, more monetization opportunities, a new feature set, and so on and so forth.
What you said, that you as a 5-year-old company has to go through digital transformation, it's actually a pretty crazy thought. Anyways, rapid fire. You know the drill.
Let's go.
I'm going to ask you 5 short questions and I'll appreciate your immediate responses. Let's dive right in. The first question is, if you had to give one piece of tactical advice to a B2B infrastructure founder in Latin America who's trying to win enterprise clients, what would it be?
You don't have to be perceived as a startup company because it's all about trust, and enterprises will hardly ever buy from a startup. So you need to do whatever is necessary to de-risk that decision-making process for the enterprise. So the least you are being perceived as a startup or even as a scale-up, the better.
What's one question founders should ask VCs, but almost never do?
Oof, difficult. I'm not sure if there's one question, but ultimately, if you're really and truly trying to build a generational company, you need to be able to find those very few that will be truly committed to whatever you're doing in the region that you're doing and for the amount of years that you need to do it. Because that's very different from the incentives that, funds and partners have.
Amen to that, actually. This is a big one. What is the most underrated or under the radar company in Latin America today?
Oof, so difficult. To be honest, I don't like talking about other companies, not even companies that I have invested into. First, because I think it's disrespectful to, the founders and the teams because you're not there and you're not facing their challenges. And secondly, because I think your playbook might be very, very different from, other people's playbooks for success. Having said that, a company that I like a lot is called Null.
Null.
Yeah, Null. These are former Mercado Libre and Wildlife people that built, a developer stack for companies to manage their development much better. I think it's a very, very solid company and really flies under the radar.
I've never heard of them. Now I'm going to go and look them up. Final one. No, 2 more. If you had to start Pomelo again tomorrow, what would you do differently in the first 90 days?
Great one. So in the first 90 days of Pomelo, we hired a lot of people. Because when we started, we already had our seed round. Literally, we had the $10 million when we started the company. So we hired a lot of the plug and play people, probably about 30 people in the first 90 days. So I would do 95% of what we did. I would do it the exact same way again, but with a third or a fourth of the team size.
Final one. What's more important, passion or perseverance?
I think perseverance. Generally speaking, LATAM has a lot of the talent and the passion. It's already embedded. It's kind of native to a lot of the people that start companies in LATAM or emerging markets. I think the perseverance speaks a lot more about the framework, and that's one thing that tends to lack a lot more. And that's one thing that I really encourage and would like to see more and more in LATAM and beyond. So that's why I am inclined to that side of the answer.
I love that. I love that answer. I actually love all of your answers. And obviously, I went through our first recording and my notes, and it's amazing to have this opportunity to see how you evolved, how the company evolved. and it's just still scratching the surface. And I'll be definitely vouching seeing you building global business from Latin America, from Argentina. Thank you for sharing that, and thank you for being here today.
No, of course. Thank you very much for the very kind comments. It was very fun. Thanks for coming down to Buenos Aires to record this episode.
If you enjoyed today's conversation, please follow and rate us on Spotify and on YouTube at the J-Curve Podcast. Subscribe to our newsletter at blog.thejcurve.com and come hang out with us on Instagram. You can find me at Olga Maslikhova with a KH.